Hi, everybody, and it is my absolute pleasure today to be joined by Dr. Adrian Saville, the CEO of Cannon Asset Management, but that's just where he is now. And before that is a trail of a really interesting life and one steeped in the worlds of finance and economics, but also strongly rooted in South Africa, the context of sustainability that we find ourselves in. And I'm hoping to have a discussion with Adrian today around the markets, around the role of ESG in particular and sustainability. We're having this conversation today in the midst of one of the worst crises that we have seen as a globe, in the form of the COVID-19 pandemic. And in the midst of all of this, we've seen really sustainability issues come to light more strongly than they have before. Yet the issues that we know we're dealing with, along particularly environmental, social issues, of course, governance ones as well, we know have been problematic for decades in the past. So what is different now and where are we going to go? So Adrian is also a professor of strategy, economics and finance at the Gordon Institute of Business Science and runs Cannon Asset Managers, has the distinction of having spoken on almost every continent in the world, barring Australia and Antarctica, and I'm sure Adrian will tell us why that is. And will share with us today his thoughts. And Adrian, I think perhaps more importantly than all the significant accolades that you have, that I'm not going to be able to go through all of them right now, I think is that you're an avid supporter of SA Inc., always have been. And so for you, the narrative around sustainability thinking is not a new one, and I think has been true to everything we've often heard you say. So with that, I mean, I want to lead with asking you a little bit about the fact that we've often seen ESG as like a sideshow. So an ESG, the acronym for environmental, social, and governance issues. And some of the common refrains we hear, particularly in relation to investments, is that it's not quantifiable, it's too subjective, it potentially means sacrificing returns if we invest in sustainability. So can I please ask you to share some of your views on this and elaborate, what you think of these sort of refrains and what your experience has been? Thank you.
Sure, it's great to be in this conversation with you. Thanks for the introduction. If you take just the measurability as a jump-off point, the fact that it's difficult to measure doesn't mean it can't be assessed. And the fact that it is difficult to measure doesn't excuse you or forgive you from looking past it or ignoring it. I mean, I can give you lots of other things that are really difficult to measure. How about happiness, as a starting point, or the strength of relationships, strong relationships, psychological well-being, social happiness are all fundamental attributes of society's intrinsic prosperity. None of them is easy to measure, but we can design toolkits and we can work out ways of not necessarily arriving at an exact number. If I tell you I'm 7.1 happy, what on earth does that mean? But we've got ways, for instance, of measuring happiness. And what we know from the design of these things called humans is that we are gregarious, we love company, we're social animals. And I could ask you things that would include the likes of when was the last time you spent recreational time with your family, a bit of a bad COVID question, but when was the last time you went to a football game? Are you on any medication for depression? Have you seen someone for therapies, treatment? And those aspects or attributes are markers. They don't give you an exact measure, but if you've got a society that is riddled with violent crime, broken relationships, and people in therapy, you've got to know things are not well here. And I would make the exact same argument of ESG, that many aspects are hard to nail down, difficult to quantify, but that doesn't excuse us or forgive us from not measuring them. I think what's also miscalibrated in this discussion around ESG is the suggestion or suspicion that if I do this, it is going to be at the cost of that. And that there is an opportunity cost of ESG endeavors. In fact, the bulk of evidence shows that there is no trade-off. In fact, emphasizing ESG translates into, well, as you would hope, more sustainable and more stable returns. Maybe just another sort of third opening comment is that it's ESG. There are elements of ESG that make it fairly easy to pay lip service, that you can do window dressing, and that you give the appearance of, painting schools, vegetable gardens. This is a bit like putting a lipstick on a pig. Eventually the lipstick wears off and you're left with the original animal in all its state. So, ESG is not something that can is not something that can be superficial, or that you can point to and figure out a committee that's going to do this and make sure that you've complied with all of these conditions. ESG is actually intrinsic to your enterprise, to your entity.
Okay. Thank you, Adrian. And I think the sort of the lipstick on a pig comparison is a very interesting one, and certainly brings into view this notion also of, reporting, for example, for reporting's sake, versus actually fundamentally changing the way that you think and integrating this into the heart of your business model, your strategy, and what your value is to, and how you perceive your value to a society. And on that,
you see this in lots of places. Let me try that sentence again, or observation again. But to me, the equivalent would be a business that commits to transformation, or a business that shows a scorecard that represents transformation. The one is endemic; it's in the DNA. It is a core purpose of the enterprise. The other is a tick box.
Mm-hmm. And that actually is a great segue, because my next question is actually around South Africa, and of course, our BEE and our scorecards are integral in terms of our broader ESG and sustainability landscape in South Africa when you consider local context. So, as a strong supporter of SA Inc., how do you view the relevance of the particular ESG matters locally, and maybe you can help us contextualize ESG in South Africa? And context matters so much when we have these conversations. So what in your view have you seen as being important, and actually translating it to outcomes on the money side?
ESG is important everywhere. It's been important for a very, very long time. The fact that it's it's been important forever. The fact that it's gaining prevalence and getting an increasing share of voice is, I think that is a comment back on the environment, rather than that this is some sort of fad, and that this will pass, and in 10 years' time or 5 years' time we'll be talking about something else. ESG has forever been important, in the same way that sustainability from an environmental perspective is critical. If you aren't able to sustain your society, your business, you have an extractive enterprise. If you've got a business or an enterprise that is poorly governed, it's only a matter of time before poor decisions and misallocations and shortcuts catch up on the business. And if you've got a business that pumps effluent and kills its surrounds and doesn't pay any price for the damage it does to society, none of that is viable. We know that from the Lorax. So there's nothing new or novel in ESG. There's nothing fleeting. It's intrinsic to building an inclusive and sustainable society, inclusive and sustainable businesses. And importantly, there's no opportunity cost. You don't have to, in doing one, it doesn't compromise the profitability of your business. In fact, if anything, it underpins it. But from a South African perspective, which is really your question, what worries me deeply is that we haven't really got this between our teeth, that there's very little evidence that South African business has taken this to heart. Now, that might be the case that many businesses have got so many other things to worry about. South Africa starts on the back foot, and when you step into an environment that is already off the pace, and you've got to worry about that and that and that, then it might be, well, this just is lower down on the to-do list. When you look at the scoring of South Africa from a Sustainable Development Goals perspective, it's clear that we've got a long, long way to go. In some ways, this is entirely unsurprising, given that one of the backbones of our economy is extractive industries. And then we can go to things that might sort of resonate more easily with people listening in on this conversation. So things that we see around us every day. Economic exclusion, glaring inequality, a youth unemployment rate that sits at 55 or 60%, female participation in the workforce, an absence of female participation in the workforce, an economy that has been starved of investment for more than a decade. So there's no shortage of evidence that South Africa comes into COVID-19 in a state of crisis. What I find somewhat dismaying is that it has required this crisis for us to agree that we are in crisis. South Africa has been in crisis for a long time. If I handed you a can, and on that can it had a descriptor that said unemployment rate 30%, per capita income the exact same as 10 years ago, an investment rate of 15%, which is just replacement capital, it's not new capital. Your share of world export market has been shrinking for 30 years. Your youth unemployment rate sits at 60%, and you've got the most skewed Gini coefficient, income inequality in the world. How's your country doing? How you can't agree, that is a place that is in crisis, I don't know. Yet we were hard pressed to get a big voice calling South Africa in a state of crisis. Maybe now we can agree, and if we can agree on that common assessment, we can start to turn it to common purpose.
Thank you, Adrian. And I think, the case that you've made for the fact that we've already gone into crisis, and, we've been in crisis for a while and just not been able to agree on this, in a way potentially makes it harder for prioritizing ESG in investment decision making. But I also gather that, in fact, it should make it even more pressing because of the consequences of the economic fallout, because of the inequalities that it precipitates, and those sorts of issues. So maybe you can give us your view or your reflection on the sort of adoption of actual ESG factors as part of investment decision making in South Africa, from your experience and what you've seen in an industry that you're the CEO of an asset manager at this point.
So from an investment perspective, pulling ESG into process runs the risk of it being turned into we have to do that in order to satisfy that, we have to do that in order to satisfy that. So there's an artificial aspect to this, and that artificial aspect will make itself evident if it isn't integral. So the issue with ESG, I think, is not to work out how we ensure that our investment process complies with such and such criteria, but rather to understand the point of departure is, well, why on earth does this matter? Why does ESG matter? And if we can get agreement that ESG matters, then it's actually difficult to make an investment process or just design an investment process that doesn't have this fundamentally built into decision making. And perhaps, you know, some throwaway comments or observations will help. If I said to you, you don't have a country, then you don't have a company. And if I change any one of the E, S, or G components, you can probably arrive at the same conclusion. If you don't have governance, the system will catch up with you. If you don't have a society, you've got an extractive business. If you don't have an environment, you've got an unsustainable business. So remove any one of those and your business isn't viable. And if investing, in our minds, we think of investing as worrying about really three fundamental questions. The first question is, am I buying a good asset? And a good asset is about sort of, you know, the balance sheet, the income statement, the cash flow. That's a good asset. The second attribute of investing is, am I buying this good asset at a good price? Because paying a very high price for a great asset isn't a good investment. You've just made a bad investment, but you own a really good business. So the second attribute is, have I paid a good price for this asset? And then the third is, does this enterprise do good? Does it leave society better than it found it? And if you've ticked those three boxes, I think you've solved what is an intrinsically, I mean, investing is not a straightforward process. It's not just, okay, well, we've got a good asset, good prices, it does good, tick, 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 you know, go and buy it. Each of these aspects is complex, complicated, intricate, and you need to establish a deep understanding of all of these. But if you can get those three attributes right, you've made a good investment. If you get any one of them wrong, you've made a bad investment. And it's that last part about businesses that, you know, do good, and it's not feel good. It's that they fundamentally behave well, that people who work there do well, that the products that they produce are sustainable, are viable, that the services that they generate leave society better than they found it, and so on. And the investment process is about making sure that all three of those are in the decision making.
Thank you, Adrian. And I think that, you know, the elements of ESG are underpinning across those three elements that you've spoken about when you're looking at an investment and how you make decisions. But some of the issue has been, again, you know, to the first point we discussed around this inability to quantify some of it. And we know a huge part of the issue is that, by and large, we've often externalized these internalities. Oh goodness. We haven't internalized the externalities, and that's what I was trying to say. So we haven't internalized the externalities, which means that we're not able to properly measure. So even the way in which we've priced some of these assets has excluded some of the costs potentially to society. And so we almost have an artificial view of what is profitable and what is not sometimes, because we haven't, in particular, I think, brought into play the third element, which we talked about, is what is its impact on society and what does it do? And that's where some of the issues come in. But notwithstanding that, and you know, the refrains around it not being quantifiable, and many of the reasons for why we shouldn't immediately do it, and this pervasive sort of short-termism that we see in the market, surprisingly, we've seen mounting evidence globally that ESG-aligned instruments have been outperforming the traditional market benchmarks. Now, I think for some of the sustainability practitioners in particular, this is the holy grail, right? You see, it worked, and it didn't cost you. And not only did it not cost you, it actually resulted in outperformance in some instances. And so that's, you know, interesting. And also, I think the evidence has been that it's not just now, because we've certainly seen the evidence during the pandemic and, you know, widely publicized reports, BlackRock, Morningstar, that have talked about ESG funds and how they've performed in these crises. But we have evidence even from the last financial crisis where continually there's been resilience built into this. And so are you seeing similar trends locally? And I mean, should it even matter that there's outperformance? Because, you know, to your point earlier, this should be integral to how you think, because a business is not going to thrive in a society or an environment that's failing. And so just, you know, give us a sense, are you seeing these trends locally, and should it even matter, or to who will it matter?
Yeah, look, I think that there is a growing evidence and growing concern. There's Now, for a number of years, the last 10 years, I've been involved in projects at the business school, research projects at the business school, which researches the ingredients that are common to countries that we would describe as miracles. And the reason why I use the air commas miracles is because they're actually not that miraculous. It boils down to a small set of common ingredients, and those common ingredients include societies that display high rates of saving, that underpin high investment rates. They've got more people coming into the workforce than going into retirement, so they've got a demographic pyramid that looks like this. They have got, sort of drum roll, ta-da, strong institutions and robust policies. That's the third ingredient. Ingredient 4 is education. Ingredient 5, which prior to 2020 was a very hard ingredient to motivate for, it's health. And the 6th ingredient is openness or connectedness, that we do better by collaborating with others. What I love about the 6 is that they are almost common sense, that there's only 6 of them. You don't need 27 of them to build a great country, and that they speak to sustainability and inclusion. If we score South Africa by those metrics, we were in the relegation zone over the course of the noughties decade, and in the most recent decade we were relegated to the B division. So South Africa has lost traction in these critical factors. And if we are serious about building a society, building an economy, making good investments, I think you have to put this at the heart. Of course, you could focus just on investment returns, and you might be able to achieve short-term returns that beats, you referred to outperformance, so you're always trying to beat something. It might be just yourself, but outperformance. And yeah, those opportunities are available, but I think the word there that you want to underline is opportunities, because it is opportunistic. There is nothing about it that is repeatable, and to me the word investing needs to be fundamentally distinguished from the word trading. That investing is a multi-year, multi-decade enterprise. It's about where we're going to land up over many, many years, not where we're going to land up over next month or next quarter or even next year. And if you agree with my definition, or if my definition of investing holds water, then you have to put these things integral to the system. And to answer your question, South Africa has not yet got that between its teeth.
And Adrian, those 6 factors that you mentioned, there's a massive overlap between that and the SDGs and the SDG targets, right? Because they're fundamentally connected. Yeah, exactly. You've mentioned education, you've mentioned health, you've mentioned the demographic, okay, in terms of people entering the workforce and people retiring. But the demographic also then talks to the youth dividend that we could see, particularly in those economies, and that should be harnessed. But with the deficiencies within those economies, with the inability to create those jobs, we're not going to be able to harness those. And you've taken the conversation on ESG and put it right back into the fundamentals of making that society work. And I think that really is what we're looking at when we're talking about sustainability. And and that's great, because I think it allows us to speak a little bit about that SDG agenda. And we know that this is something we all need to lean in on, and you couldn't have put it more articulately as to why that matters in practice. And we hadn't even talked about the SDGs before you mentioned that. So some of the issues that it seems to address, we have seen the consequences very clearly, because as we deal with the pandemic in particular, and
just before you go to the SDGs, can I interrupt you very, very quickly and just underline that, although I'm painting these 6 factors at a 30,000 feet, as you rightly point out, when you start digging in, you start finding all types of gold or treasure or nuances. So when you go into demographic, for instance, there's the youth dividend. When you go into demography in many countries, what you find is women are left behind.
Absolutely.
And, you know, let's not talk about South Africa. Let's talk about Japan, which for the past 10 years has been emphasizing the inclusion of women into the workforce. And guess who pays the highest price of COVID-19? It's women in the workforce in Japan. So, you know, you can, when we drill into health, it's not just physical health. It's not just, you know, am I free of certain ailments? It's also psychological health and emotional health. So the wellness and well-being of a society, the prosperity of a society is complex and multifaceted, but it can be quickly assessed and interpreted through what I think is a very convenient lens, and a lens that speaks to the evidence that's coming from the SDG and the ESG terrain. Sorry, I interrupted you.
No, thank you, Adrian. And you know, that's just, it's hugely important because it's making the case for why this matters to us. You know, suddenly these intangibles are very tangible. You know, we know the multiplier effect of women entering the workforce, you know, and how that translates into empowerment, how that translates into actually having more active, you know, children who are more engaged and willing, and creating that mindset going forward. What it does when you have women as part of decision making, from diversity, and being able to actually change the dynamics even from a boardroom perspective, how it reduces incidences of things like domestic violence, for example, once you have a different level of financial independence, for example. And you know, just that huge impact that I think exists there, that we all need to take cognizance of. And you know, we try and put this together in indicators like gender equality, but it's that multiplier effect that you've spoken to that really is the thing we're trying to unlock when we're promoting these matters and understanding what that impact is and why it should matter financially, I think, if I understand what you were saying correctly.
Agreed, absolutely. And so just as the point that I'm making, when you drill into these factors, there are some nuances and intricacies. The impacts and implications are also nuanced, but they have, your word, multiplier effects. They have spillovers, they compounders. Female participation in the workforce translates into financial inclusion. It translates into healthier families. It translates into more educated children. All of the things that you've observed. And when you put those components together, you've got a society that is intrinsically better off. Yet somehow we walk past this. We pretend it doesn't matter, or we push it down the list of importance. It's bizarre. It's very dysfunctional decision making, that we behave as if this is a nice to have, rather than what on earth are you doing? You have to have this.
Absolutely. I think we need to quote you on that. This is very dysfunctional decision making if we're thinking we don't need to have this. And I'm hoping that really, if nothing else, is the outcome and what we learn from the situation that we're in right now. And you know, I think the integration then of the SDGs into actual investment decision making, perhaps then is the natural next question for us. And we know that the financial sector has a massive role to play, and in many different ways, and that investment decision making is just one of those ways. But maybe you can give us a view on that, Adrian, either through the investment lens or through the broader sector view. And ideally, if you can reflect on both, I think it will be hugely beneficial.
I hope I've understood your comments and observations correctly. So from an SDG perspective, you know, one of the challenges with the SDGs is there's lots of them, and trying to achieve one of them. Trying to achieve all of them means that you're probably likely going to achieve none of them. That arguably there is a place here for prioritization, and prioritization to recognize what can be achieved and where and how you're likely to have the greatest impact and influence in terms of any one of those SDGs. So, you know, for Rwanda to worry about the ocean environment, well, that's a bit of a nonsense. But for Rwanda to worry about female inclusion, that's critical. For Rwanda with a young population to worry about young people is critical. So you need to assess those SDGs, I think, in the context, in the environment, and realize that if you pursue all of them, you may land up achieving none of them. Again, that doesn't forgive you from saying, well, therefore I'm going to give up, but prioritizing and ranking. And what we also know is that some industries are likely to have far more profound impact or influence on some SDGs than others. So for instance, I've been doing some work recently with a private equity business, helping them build an impact scorecard. And I think the work that they are doing, I don't think it's appropriate for me to advertise them here, but the work that they're doing, their identity will probably become known not too far from here. But the work that they're doing is ahead of many of their peers. And it's important work because it's about the impact of their capital allocation. And if they're putting that impact at the head of capital allocation, they can then go and ask, where is our capital going to have the greatest impact? And SDG 9 is where ICT has biggest impact. So if you're an ICT firm, you might want to worry most then about SDG 9 rather than the ocean environment, for instance. So it's not a one size fits all. It's not a, well, everyone must tick every SDG box, go. It's where can my dollar have biggest impact? Where are my spillovers, linkages, multipliers going to be greatest? Some dollars will have far more profound contribution by virtue of the fact that they are last mile dollars. That in no way negates first mile dollars, because for the last mile to happen, the first mile has to happen.
Yeah.
And that then also, I think, really underlines that the investment system is exactly that. It's a system that, although investment decisions might be taken by teams and committees and portfolio managers, they all feed into this greater thing called the economy and society. And the ultimate evidence of that is our achievement as a collective of the SDG goals.
Sure, thank you, Adrian. I think, yeah, of course. I think you've laid out quite simply what really is so logical and to be honest, fairly simple, right? It's what is your role in society? Where are you likely to have the biggest impact? And therefore, where's your opportunity to influence the achievement of the SDGs best? And I think it's that lens of understanding what I can influence, but I think you've also sort of alluded to the fact that it's also kind of considering what those SDGs are and therefore what you could do differently potentially to be able to, make a concerted effort to actually look at changing that landscape. And that's fairly simple. I mean, it's like understand what they are, know your own impact, and then understand how you can use that impact to influence the attainment of the SDGs. And that sounds fairly simple, but I think it starts with intent, and it certainly starts with leadership that's willing to see and make that connection to why this is important. And you've set out to us very clearly throughout the interview as to why this is important economically for any country. So I think I'll leave you with some closing thoughts then, Adrian. That takes me to the end of what I really wanted to get, from our interview and our chat today. And you've given us, I think, far more than we hoped for, and very grateful for that. And also, I think, for your continued influence on the space and the passion and dedication and your willingness to speak openly and so practically about it is very much appreciated.
Thank you. And as we go from here, my appeal would be that there's no lip service paid to this. That if you get it, it's intrinsic. It's built into the DNA of your decision making. The alternative is lip service. It's cosmetic, and we will be back at COVID-19 or some variation of this in that future. So thank you for inviting me to share thoughts.
It's an absolute pleasure to have you, Adrian. Again, thank you very much. And to everybody who's watching, that was Dr. Adrian Saville, CEO of Cannon Asset Managers, and also a professor at the Gordon Institute of Business Science in Strategy, Economics and Finance, who has spent very valuable time today telling us why sustainability thinking matters and how it translates into economic progress and why this should be intrinsic. As we go into the decade of action in relation to the SDGs, with us sitting now at a precipice at this time of the pandemic, I think it couldn't have been more timely. Thank you, Adrian, and I hope we'll chat again soon.
Thank you.
Okay.